Hello everyone, hope you are doing well. Today we are going to discuss about monetary policy. What is monetary policy? Monetary policy is the macroeconomic policy laid down by the central bank. It involves management of money supply and interest rate. Central bank supervises and regulates banks and implements monetary policy. Money supply is all the currency and other liquid instruments, for example, cash and deposits. Okay. So, for example, in Bahrain, the Central Bank of Bahrain (CBB) is responsible for setting and implementing monetary policy. Now, monetary policy can be broadly classified as either expansionary or contractionary. In the case of expansionary monetary policy, this means lowering interest rates. Okay, so when the central bank charges lower interest rate, so the borrowing costs are lower for commercial banks, right? With lower borrowing costs, commercial banks can charge customers lower interest rate for their loans. As a result, the economy has greater money supply overall. So expansionary policy increase the total money supply and it is used to fight unemployment. Okay. On the other hand, government employs a contractionary monetary policy to fight inflation, okay, by reducing the money supply within an economy through increase the interest rate. The demand for money. The price of holding money balances is the interest rate. The interest rate is the opportunity cost of holding money. So as the interest rate increases, the opportunity cost of holding money increases and people choose to hold less money. Okay, so basically the demand for money refers to how much assets individuals wish to hold in the form of money. The opportunity cost, as I said earlier, it's the money, it's the cost that could be realized if the money were invested instead of held. So let's take an example to make it clear. For example, instead of holding $1,000 in currency, we could invest the $1,000 in interest earning bonds and earn interest, right? So in this case, if we choose to hold the money in form of cash, the opportunity cost is losing the interest earning bonds on the $1,000. Why low interest rates? So normally lower interest rate leads to two things. First, savers spending more as the opportunity cost of holding cash has reduced because lower interest rate make it less attractive to keep your money trapped in investment. Okay, so individuals and business want to hold cash and deposits account rather than, for example, investing in bonds and stocks whenever the interest rate is low. Okay. Also, it results in cheaper borrowing cost for businesses and consumer, resulting in an increased expenditure. So the lower the interest rate, people are willing to borrow money to make big purchases, okay? For example, such as buying houses or cars. Hence, it will increase the expenditure. Supply and demand for money. So on graph A outlines the relationship between the interest rate and y-axis and quantity of money measured on the x-axis. Okay, and it's called the demand for money. And it shows that there is an inverse relationship between the interest rate and the quantity of money demanded. This inverse relationship reflects the fact that higher interest rate makes it more costly to hold money. Okay, so the higher the interest rate is, okay, the lower the quantity of money. Okay. In graph B, as we discussed in the previous chapter, the amount of money in the economy is determined by the monetary authority, right? So for example, the Fed in the case of United States. So as you see, the money supply is vertical. Okay, the vertical supply curves reflects that quantity of money determined by Fed policy is not affected by change in interest rate. That's why it shows vertical line. Equilibrium in the money supply. The money supply is not only determined by the central bank because both the banks and the public are important players in the money supply process. So this graph brings money demand and money supply together and shows how they determine the equilibrium rate of interest. The money interest rate will move toward I1 when the quantity of money demanded is just equal to quantity supplied by the Fed. Okay? At the equilibrium interest rate, people are willing to hold the stock of money the Fed has supplied to the economy. At an above equilibrium rate of interest, which is I2, people will not want to hold as much money as the Fed supplied, means they will try to reduce their money balances using some of their money balance to buy bonds, stocks, investment, and so on. And here we are facing excess supply of money. At the below equilibrium money interest rate, I3, for example, an excess demand for money will be presented, means people would like to hold a large quantity of money, means cash, than the Fed has supplied. In this case, people will sell some of their bonds or investment they own to get more money in turn. The direct effects of monetary policy. There is a direct link between the money market and the goods and service market. And an increase in the money supply means increase in aggregate demand, increased real GDP, increased prices, and a decrease in unemployment. So here we are facing expansionary monetary policy. On the other hand, contractionary monetary policy takes place when there is a decrease in the money supply, which means a decrease in aggregate demand, decrease real GDP, decrease prices, and an increase in unemployment. Expansionary monetary policy graphs. The first graph shows expansionary monetary policy in the money market. And as you know that expansionary monetary policy makes most sense during a recession. The money market shows how the demand for money and the supply of money interact to determine the interest rate. Note that demand for money is downward sloping and the supply of money is vertical. Now when the central bank buys bonds, it increases the money supply, right? And as a result of the increase in the money supply, the interest rate will decrease. As you can see, the policy lowered the interest rate. So at this point, the interest rate is lower. Now the second graph explains how government is used expansionary monetary policy and the effect this has on real GDP. When the Fed increases the money supply, interest rate fall and the quantity demanded of goods and service increases at each and every price level. The aggregate demand curve shifts from AD1 to AD2. The result is greater real GDP growth and a higher price level at this point. So at this point, we are having a higher real GDP and a higher price level. So in this case, the Fed has eliminated the recession. Monetary policy and the problem of recessionary gaps. Question 1. What causes the short-run aggregate supply move to its new equilibrium in point B? Question 2. Why might the use of monetary policy in C to close the recessionary gap be preferred to the correction in B? Now in graph A, the economy operating at a level below its equilibrium. Recessionary gaps are characterized by high unemployment and low price, and this gap can be closed either by a shift in short-run aggregate supply or by expansionary monetary policy. Now in graph B, they close the recessionary gap by a shift in the short-run aggregate supply, and the way this happens is low price leads to lower nominal wages, which leads to a right shift to short-run aggregate supply, closing this gap. On the other hand, graph C, they close the recessionary gap by expansionary monetary policy, which will increase the aggregate demand, and this will push up the price level and increase real GDP. Monetary policy and inflationary gap. Same questions, but this time with inflationary gap. Here we are facing overemployed situation. Means that employees working overtime and their salaries will increase, right? So this increased cost of labor and will cause producer to reduce supply, shifting supply curve to the left. Contractionary monetary policy would reduce aggregate demand, returning to its new equilibrium on the long-run aggregate supply without inflation. That's why using monetary policy in C to close the inflationary gap be preferred to the correction in B. Expansionary monetary policy and no change in real GDP. If expansionary monetary policy is anticipated, worker may bargain for and receive a higher wage rate. It is possible that short-run aggregate supply curve will shift leftwards. To the degree that expansionary monetary policy shifts the aggregate demand curve rightwards, the result no change in real GDP. So if you notice that the new equilibrium points is equivalent to the old equilibrium points, okay? So there is no change in real GDP. Interest rate effect on other markets, indirect effect. Monetary policy works through the interaction of three markets: the money market, the investments good market, the goods and service market. When the money supply increases, an increase in the money supply lowers the interest rate, right? Which causes investment to rise and aggregate demand curve to shift rightwards. Real GDP increases and the unemployment rate drops at the cost of higher inflation, okay? So here we are trading off between the employment and inflation. As I explained earlier, monetary policy works through the interaction of three markets: money market, investments goods market, aggregate goods and service market. Let's look at money market. The increase in the money supply leads to lower interest rate. Investments goods market, the lower interest rate causes investment spending to rise. So at point B, when we lower the interest rate, investment spending is higher. Aggregate goods and service, higher investment spending means that the aggregate demand increase, okay? So shift to the rightward. The increase in the aggregate demand results in an increase in real GDP. So at point Y2, real GDP is higher than Y1. Exercise: drawing the effect of monetary policy. Try to reproduce the three graphs we looked at in the previous slide side by side to show the effect of contractionary monetary policy. So in the previous slide, we saw the expansionary monetary policy. Now try to draw the three graphs in the case of contractionary monetary policy, okay? The money market, investments goods and market, and aggregate supply, aggregate demand market. Limitations of the monetary policy. These two scenarios below could be seen as the limitation of monetary policy. Investment is not always responsive to the interest rate. So when investment is completely insensitive to the change in interest rate, the investment demand curve is vertical. An insensitive investment function is one that is not affected by a change in interest rate. For example, a decrease in interest rate induced by monetary policy does not result to increase in investment level. For the case of the private investment, so in this case, if we reduce the I1 to I2, the investment level will be the same. Now, in case of liquidity trap, demand curve for money could become horizontal at some low interest rate. In the graph below, the demand curve for money become horizontal at I1. This horizontal section of the curve is referred to as liquidity trap. So if the money supply increased from, let's say, S1 to S2, this is when the money market is in the liquidity trap. The money market moves from point 1 to point 2. And individuals are willing to hold all the additional money supply at the given interest rate. The Phillips curve. The Phillips curve states that inflation and unemployment have an inverse relationship, with inflation on the y-axis and unemployment on the x-axis. A higher inflation is associated with lower unemployment and vice versa. So this suggests that policymakers have a choice between prioritizing inflation or unemployment. The accepted explanation during the 1960s was that fiscal stimulus and increase in aggregate demand would trigger the following: an increase in the demand for labor as government spending generates growth, the pool of unemployed will fall, firm must compete for fewer workers by rising nominal wages, workers have greater bargaining power to seek out increase in the nominal wages, wage cost will rise, and finally, faced with rising wage cost, firms pass on these cost increase and higher price. The Phillips curve trade-off. The Phillips curve illustrates the trade-off between unemployment and inflation. A little more of unemployment means a little less inflation, and vice versa. So if you notice at point A, the unemployment is 5% and inflation is 2%. And at point B, the unemployment is 3% and inflation is 6%. It's an inverse relationship. Real interest rate. Real interest rate is adjusted to remove the effect of inflation. The real interest rate shows how much more you can buy. For example, it gives the real rate of a bond or loan. To calculate the real interest rate, you need to subtract the actual or expected inflation from the nominal interest rate. Let's look at this exercise. HSBC offers you 3.7% interest, so this is nominal. Inflation is 3.5%. What is your real interest rate? 2. Citibank offers you 3% interest. Again, this is nominal. Inflation is 1%. What is your real interest rate? And finally, BBK offers you 5% nominal interest rate. Inflation is 7%. What is your real interest rate? Answers. Now, in order to calculate real interest rate, we need to subtract inflation from nominal interest rate, okay? And if you notice in the last example, we have a negative real interest rate. Why? Because the inflation is higher than the nominal interest rate. Exercise monetary policy. Work in a group or individually to answer the below question. Imagine Bahrain has 9% unemployment and 2% inflation. What monetary policy would you use? Illustrate your policy on the following graphs: money market, investment goods market, goods and service market, and finally Phillips curve. Multiple choice question. Question 1. Monetary policy affects both inflation and output. Question 2. In the ASAD model, expansionary monetary policy, the answer is A. Increase in aggregate demand by a reduce in interest rate. Question 3. Which of the following gives the correct relationship between nominal and real interest rate? The answer is D. Real interest rate equals to nominal interest rate minus inflation rate. As the level of interest rate in the economy falls, the demand for money, ceteris paribus, the answer is A, increase. So people want to hold cash and deposits account rather than, for example, investing in bonds and stocks whenever the interest rate is falling. 2. An increase in the level of income will cause the demand for money to increase. True or false? The answer is true. So, for example, a household with an income of 1000 BD per month is likely to demand a large quantity of money than a household with an income of 500 BD per month.